Whether you want to admit it or not, losing money is a part of investing. However, the difference between smart investors and bad investors is that smart investors know how to use losses to their advantage, specifically how to use those losses to pay less in tax through a process called tax loss harvesting. And that's exactly what we're going to dive into in this video. So in today's video, we're going to cover what is tax loss harvesting. We're going to discuss why it's important and why it's something you should know about. We're going to talk about a step-by-step explanation as to how tax loss harvesting works in a nutshell, and we're going to go over some important things to keep in mind throughout your investing journey as you go through the process of tax loss harvesting to save you thousands of dollars in capital gains tax in your investing journey. So let's start off with the basics. What exactly is tax loss harvesting? In plain English, tax loss harvesting is when you sell investments at a loss on purpose. And the intent here is to use those losses basically as like a write-off against other gains that you have inside your investment portfolio. And the thought process here is the less gains that you report on your tax return, the less money that you're gonna have to pay in capital gains tax. And again, this is something that all smart investors know how to do. And it becomes more important the more that your wealth continues to grow, and of course, as your income continues to grow over time. So as a quick example, let's say in the past you bought $3,000 worth of ABC stock. The stock has had some issues, it's really had some troubles, and that stock falls, your position in ABC stock falls down to $2,000, and you decide to sell the shares. So what's happened is you now have a $1,000 loss that you can potentially use as a write-off against other gains in your investment portfolio. So that's the essence of tax loss harvesting, is really just using losses in your investment portfolio to reduce the amount of gains that you're reporting, which can potentially save you, as we'll talk about here in a second, thousands of dollars, if not more, in capital gains tax. So what are the benefits of tax loss harvesting? Like, why is this important for you to know? Why is this something that you should be doing as your wealth continues to grow and as you get closer to reaching your financial goals? Let's talk about that. So there's tons of benefits. I want to keep this at a high level, but the first one being, of course, it can reduce the amount of capital gains you have to report. All else being equal, a smaller amount of capital gains you report on your tax return will turn into a smaller tax bill, right? It's just common sense. If you're reporting higher gains, you're going to have a higher tax bill compared to if you're reporting a smaller amount of gains that'll result typically in a smaller tax bill rather. And I don't know about you, I feel like I already pay enough in taxes as it is. And if it were up to me, I'd want to reduce the amount of taxes that I'm paying, and I'm keeping more of that money in my pocket, in my portfolio, so it can continue to compound for me. And there is an instance where your tax loss harvesting can also reduce your gross income that you report. So your W-2 income, your income from work or from your business. I'll probably make a separate video on that topic, but just for the time being, let's focus on the fact that the main purpose of tax loss harvesting is the fact that you can use it to reduce the amount of capital gains that you're reporting on your tax return every single year. So let's do a quick rundown so you understand at a high level how tax loss harvesting works step by step. So the first step in the tax loss harvesting process is to identify investments that are underperforming or you're ready to move on from in order to start the process of selling those investments at a loss to use those losses for tax loss harvesting purposes. If you're self-directing your investments, or in other words, you're a DIY investor, a great opportunity to find these types of investments is usually during your portfolio reviews. So if you're checking on your portfolio maybe once a month or quarterly or however often you are, this is usually one of the best times to check in on your different investments and see, hey, is this investment kind of underperforming? Is it not really doing what I expected to do in my portfolio? Does it no longer have a spot in my investment strategy? These are great questions to be running through your head as you're reviewing your portfolio, looking for these tax loss harvesting opportunities. So another thing here before we move on is you want to make sure you have a good reason to sell as well. Whether it's gains or losses, we never want to just sell investments for the sake of selling. There's plenty of good reasons to sell, but we want to make sure that we have a clear one before we hit that sell button, which leads to step number 2, which is, of course, to actually sell the shares. One thing that's important to note about tax loss harvesting is paper gains and paper losses do not count. You need to actually sell the investments at a loss, lock in those losses in order for those losses to be in play. in order for you to be able to use those losses as a write-off against other gains. And on the other side of this, it's important to understand that you can only use losses that you've locked in against other gains that you've locked in as well. So you can't use losses that you've locked in against paper gains. Really important for you to understand. But nonetheless, step 2 is to sell the shares. Step 3, really important. I see a lot of people skip over this or get this wrong. You want to avoid something called the wash sale rule. And this is kind of a tricky rule. I'm sure I'll make a video on this at some point in time. But basically, the way the wash sale rule works is if you fall victim to it, you aren't able to typically use the losses that you locked in against other gains, which kind of defeats the purpose of selling the investments at a loss in the first place. Long story short, this is a 61-day window of time. I'll actually move on to the next slide so you can see this with me. It's technically a 61-day window of time. There's 30 days before you sell the investment at a loss, and then 30 days after you sell the investment at a loss. Long story short, if you buy back that same investment either 30 days before the trade date or 30 days after the trade date that resulted in a loss, you lose the ability to use those losses as a write-off, essentially. So again, the wash sale rule is kind of a tricky rule. I'm sure I'll do another video on that topic at some time in the future, but for the time being, as it relates to this video, it's important to understand that avoiding the wash sale rule is key as a part of the tax loss harvesting process. And then after that, step number 4 is to make sure that you reinvest the cash. In a lot of cases, you're going to sell off the investments, take advantage of those losses, and then you're going to have a decision to make with that cash. Often it makes sense to reinvest it back into your portfolio. Again, if you're a DIY investor, this usually involves rebalancing your portfolio, using those losses and using that money to invest in maybe investments that you currently hold to get your investment portfolio back into alignment with the different percentages of the different types of investments that you want to own, right? And then there's other uses for the cash as well. You can use it to hold as cash as a cash position and wait for other opportunities. But this goes back to the fact that we want to make sure that we have a clear plan for why we're selling in the first place, and then also in advance what we're going to do with the cash. So step number 4 typically is to reinvest the cash or use it for whatever reason you're intending on using the cash. And then step number 5, this is crucial. Come tax time, you're going to have to report what you've done in terms of trades in your investment accounts for the year. So the platform that you invest through, the brokerage, so to speak, is typically going to provide you with tax forms that does a lot of the math for you. But ultimately, it's your responsibility to make sure that those numbers are correct, because they're kind of just doing you a service by providing you those numbers, but they're not liable as to whether or not those numbers are right. So it's really important to keep track of the different trades that you're placing. Again, if you're a DIY investor and doing the math and finding out, do I have a net capital gain for the year? Meaning when I subtract all my losses that I've locked in from my gains that I've locked in, do I have a gain, or vice versa? Do I have more losses than gains to report, right? That's on you ultimately, and this is going to be something that you're going to report come tax time. But this is also a great opportunity to figure out how much tax savings am I taking advantage of through the tax loss harvesting process. So let's do a quick example to further cement this into your mind, because again, I want this to be clear, and I want to make sure this is something that you understand, you actually see why this is valuable for you to do. So let's say that you've had a good year on the market and you've locked in $100,000 in gains across your different taxable accounts. And all else being equal, you would have to owe capital gains tax on that full $100,000 if you aren't reducing it by any way. Now, let's say that you also lock in $50,000 worth of losses. Maybe you had some stocks that just didn't pay off, they didn't pay off as you had planned, rather. Maybe you made some bad investments during COVID, which I'm having a lot of conversations with clients about that. Or, maybe you just invested in something that didn't pan out. Again, it's part of the process. So what happens here is, instead of being responsible for capital gains tax on the full $100,000, because we locked in that $50,000 loss on those investments that no longer fit our portfolio and we decided to move on from, we now only owe capital gains tax potentially on $50,000. And as you can imagine, we're talking about thousands of dollars potentially in tax savings here. And like I said earlier, the more that your investments continue to grow, the more that your income continues to grow, the more important this is for you to understand and apply, because it's about not only growing your wealth, but also protecting it, and protecting it from things like taxes. So moving on, let's talk about some important things to keep in mind as we start bringing this for landing. Some things to keep in mind here are, number one, if you are a DIY investor, if you're self-directing, if you're calling the shots with your money and you're investing, tax loss harvesting is your responsibility. This is something that you must be able to do if you plan on building sizable amounts of wealth and taking control over that money that you have in your investment accounts. This isn't something that would be nice to do. This is a must. If you're working with someone that's managing your investments for you, hopefully that this is something that they're providing. I know a lot of robo-advisor platforms will also offer this service, but nonetheless, it's important to know that if you are investing on your own, this is your responsibility. Another thing to note, I hinted at this earlier, is the fact that tax loss harvesting can only be done in taxable brokerage accounts. So it doesn't apply in tax advantage accounts like Roth IRAs, 529s, HSAs, 401ks, the types of investment accounts where your money can grow on what's called a tax deferred basis. Unfortunately, the IRS is not going to give you the ability to not pay taxes on your gains and also be able to write off the losses inside of those accounts as well. So a long way of saying the only way that you can take advantage of tax loss harvesting is if you're investing inside of taxable brokerage accounts. Again, avoiding the wash sale is key. This is a step that I see a lot of people mess up when they're planning on using losses to their advantage, but then they completely flush that down the drain because they repurchase the same investment within that time frame that we talked about earlier. And as always, if necessary, consult with a tax advisor. This stuff is complex, even if you've been doing it for a while. And it always helps to have the opinion of a tax professional, CPA, or what have you, when you're going through your financial planning, when you're going through your tax planning. I always recommend that with all the clients and families that I work with as well. So main takeaways from this video, I wanted to keep this semi-brief. I wanted to keep this semi-high level because this can be a pretty complex subject, but I wanted you at least to walk away with a high level understanding of what tax loss harvesting is. So again, tax loss harvesting is really the act of selling investments at a loss on purpose to use those losses as basically like a write-off against other gains that you lock in your investment portfolio. And as your portfolio continues to grow, as your income continues to grow, as your net worth continues to grow, this becomes a much more important activity for you to start taking advantage of. And as we approach the end of this year, Q4 is usually one of the best opportunities to look for these tax loss harvesting opportunities in your investment portfolio because it's based off of the calendar year, right? The tax year ends on December 31st. So really you have until December 31st to take advantage of these tax loss harvesting opportunities in your portfolio. But what I think is really important here is, again, if you're investing on your own, if you're DIYing your investments, it's really important to have a good process in place for identifying tax loss harvesting opportunities and making sure that you keep things as clean as possible, keeping accurate records so you make sure that you're doing things the right way and maximizing the wealth that you're building. So next steps from here are, if you're watching this video and you feel like you're trying to take the right steps towards investing for your goals, and maybe you have already gotten started, you've been investing for some years now, or you haven't started at all, you know it's something you should be doing, but you need some help, you need some guidance, you want to make sure that you're on track and doing things correctly. Next steps from here are, in the description to this video, I'm going to leave a link that you can click on to schedule a quick free one-on-one financial consultation with myself. That's a good opportunity for us to sit down, help me understand more about your situation, help me understand what your goals are, and see how I can point you in the right direction. So again, the link to schedule that quick one-on-one consultation with myself is going to be in the description to this video. But that's going to be it for me in this video on tax loss harvesting. I hope you found it helpful. If you did, make sure you give it a like. If you have any questions on the subject, feel free to drop them in the comments. I'll try to answer as many of them as I can. And again, if you want to sit down and have a conversation about what you're doing right now with your investments and making sure that you're on track with your goal of financial freedom or building generational wealth for your family, click that link in the description for us to schedule a quick free one-on-one consultation. But again, thanks for taking the time to watch this video, and I'll see you in the next one.